Hey everyone, welcome in to another Daily Editorial here on the KE Report. I'm featuring Rick Bensignor in this Daily Editorial, president of Bensignor Investment Strategies, writes the institutional newsletter, Supposedly Irrelevant Factors, that is read by some of the most successful hedge funds in the world. And on the retail and individual investment side, check out Rick's website, In the No Trader. He has 3 products there, a monthly report called 7-Eleven, where he picks no more than 7 of the 11 SPDR ETFs with the goal to beat the S&P, a weekly report called the Tactical Trader Report, and a daily report called the Daily Tip Sheet. That was just started this year. Rick, we usually feature you on the weekend show, but we pushed back our call from last week to early on this week, and I really appreciate you taking time with us right before the holidays kick into full swing here to really share your thoughts at the end of the year on these markets. I do want to start by recapping last week's Fed statement and Jerome Powell's press conference. Markets celebrated by having a pivot party, it was called. The Fed came out a lot more dovish than people thought, even though it was still a hold, but it was mostly all about the dot plot showing potential of 3 rate cuts next year. Rick, what do you think the significance was for that Fed statement and what Jerome Powell had to say in the press conference?
Well, Corey, thanks for having me. I think what Powell and company did was essentially recognize and acknowledge what investors had already been betting for a while, which is lower rates. On the 10-year side, we had seen the U.S. 10-year Treasury go from as high as 5% to it got down to about 4.11, bounced to 4.25 or so, and then when this came about, it was probably about 4.15, and in a matter of a couple of days, we broke under 4 and got down to 3.9% or so. The Fed is traditionally behind the curve. I think this year reinforced that statement and belief that they are not on top of things. And in this particular case, I think 2023 was a very good example of investors slash the market leading the Fed to make their decisions instead of more back in the days when, let's say, I grew up on Wall Street, we'll call it the 80s and the 90s, back 30 years ago, give or take, that the Fed kind of set the tone for how markets would trade. This round has really been investors have set the tone to what the Fed has done. They led interest rates higher before and during Fed rate hikes. The marketplace was able to essentially do the Fed's job in raising rates. And now they've lowered rates and the Fed has come down. And now, even though they haven't lowered them yet, the market has already priced in such that a lot of the Fed's job is done because the marketplace has done what the Fed would have needed to do if investors weren't as savvy as they proved to be this year. So, answering your question it is an acknowledgement of what investors had already properly priced, both on the upside earlier this year and now on the downside.
So, Rick, when it carries over to markets, we can debate all we want why the Fed's going to cut rates and when they're going to cut rates. But from a market perspective, look, as you said, the markets have, in a way, been leading the Fed. Is there still more upside for the markets now that the Fed is seemingly locked into no more rate hikes and probably some rate cuts next year?
So they are presenting a Goldilocks scenario here, and that is some of the even recent thrust that we've gotten on top of what has already been a very significant move off of the late October bottom. I think we're getting closer to a trading top that will pull back probably and tuck underneath what had been, let's say, July highs, which were near 4,600 in the S&P. So, yeah, I can make the case that we still go a little higher and even potentially take out the all-time highs at 48.19. I don't think we're going to have a major leg higher without some type of pullback first. But the pullback is one that likely should be bought. There are three unfilled gaps on the S&P chart since that October low. And I would think that sometime in the early, if I don't think we'll probably do it this year, but I would think in the first quarter of next year, there's a good chance we'll at least pull back and get to, fill in that area. And that gap is from, I think, just about, I don't know, 44.60 down to 44.20, give or take. So we could certainly see some type of pullback because the buyers now, most of the buyers are forced buyers. Of course, there's cash on the sidelines, and that will temper any of these declines into not likely being significant declines. But part of the game of investing and trading is kind of knowing when to do what you want to do and the timing of it. And I think what the indicators are showing is that despite this longer term picture having vastly improved since where we were in October and the decline that broke 42.75 in the S&P and got a lot of people bearish, it was a false breakdown. And you often see a very rubber band like reaction off of false breakdowns or false breakouts that are sharp and usually test the maximum points in the other direction. In this case, you're talking 48.19, S&P all-time highs. So we're close enough to it that we're certainly, or I don't know what, 80, 70 points away now as we record this. It wouldn't surprise me if we make new highs. Whether they're lasting or not is the question. And I would think, based on the models we use that look for and consistently identify trend exhaustion, I think you're closer to the initial move up from that October low, where you could easily see a pullback down beneath what were July highs before this finds a bottom again, and then another leg higher.
Yeah, fair enough, though. Hey, Rick, like these markets, I think, are 7 weeks in a row straight up almost on some higher volume in the last couple trading sessions as well. Now, you mentioned that one gap around the 44.60 to 44.20. What about that one gap in the about 42.50 region? That one came back in the beginning of November.
So right after we made the lows, there were two gaps made over a 3-day period. So gap up, strong move higher, and another gap up the next day. Those probably will not be touched, not in the near term, and possibly not at all for a while. When you get a false breakdown like we saw, and then these real thrusts higher, there's so much impetus behind those thrusts, news driven, and too many shorts having built in on the breakdown that ended up becoming the false breakdown. Those are kind of changes, major changes in market psychology. And I would say in my 40 plus years of playing this game, those type gaps can stick around for years. They don't need to be filled in the short term, and I doubt they will be. But the highest of the three, the one that we talked about in the 4,400 range, that one I could see, over just ups and downs that take place in the normal course of action. That one could be played with and potentially filled. But I don't think those lower ones from early November will be.
Okay, fair enough. Yeah, that initial gap, that around 44.20, 44.60, that's about 6 to 7% lower. So I guess that would be kind of a healthy pullback. But Rick, we've talked a lot about rotation or the lack of breadth this year in the market rally and rebound. What are you seeing right now? Is this a healthier market in terms of breadth, or is it still just this magnificent seven?
So it is a rounding out and an increase. Certainly we've seen small caps make a significant move. One of the key models I've used for, oh God, it's 30 years already, got its first buy signal of the entire decline that we've seen in small caps, not just this year, but since they made their all-time highs. It has now suggested that the general decline in small caps is over. So even though if you look at the IWM, which is the Russell 2000 ETF, which is how most people play the Russell 2000, even though it's still in a sideways trading range and right up against prior highs, structurally, the small cap arena has changed away from the bearish picture that has been the predominant picture for the last few years. So it doesn't mean it's a buy right here and now, but what it does suggest is that you need to start thinking about including these in your portfolio versus certainly Magnificent Seven names, but even potentially against the S&P or the Qs. Russell names, at least now, again, deserve, certainly on pullbacks, a place in your portfolio. And I haven't looked into it yet, but I will for, let's say, the next time we talk next month. I will take a look at, let's say, Russell versus a basket of the Magnificent Seven and see whether or not that's even a trade worth doing. My hunch would be that it probably is, but I don't want to put that out yet until I've done some homework on it.
Okay, well, I'll follow up with you next month then. Rick, from a big picture standpoint, then you have been very accurate when it comes to playing these markets, both when they were trending lower last year and now higher this year. Do you consider this market right now a bull market for the broad averages? Also considering, look, we just had the VIX drop down into levels we hadn't seen since 2019. There seems to be a lot of investors piling onto this bull market. Would you call this a bull market?
Yeah, I think I think I'd say yes, and that it's certainly not a bear market anymore. The price action in the last, I don't know, 6, 7 weeks is so strong. And again, I'm showing signs of very close to upside exhaustion, at least for this move that started in late October. The fact that we've come back in the range of all-time highs for S&P, Dow has already made new all-time high. Qs are, in the neighborhood. I think that the bears out there would be hard pressed to be able to defend their reasoning for why they would still stick with a bearish scenario. I just don't think the evidence is there anymore. And those who have been, and there's certainly some notable bears on the street for the last few years who might have looked very good in 2022, but basically they stuck with those calls all throughout 2023, which is now completely undone the decline from all-time highs. It's pretty hard to make the case considering, and there is a school of thought out there that not enough people, I think, embrace. But you've got all these strategists who are interviewed all the time on the street, and several of them are, let's just say, in the camp of perma bulls. The thing about being a perma bull when you're a strategist is, in my view, you've added absolutely no value to investors. Everybody knows that the stock market goes up over time. To always be bullish the stock market, I think, serves zero value. And I've seen people tweet about this. Strategists, a good equity strategist, alerts you timely to when you should not be buying the stock market. And so, for instance, if you were bearish in 2022, and especially in the early part of 2022, you saved your clients a ton of money. If you were able to get them out or reduce exposure, then they avoided a good portion of the 19% decline that the market saw in 2022. If you could have gotten bullish on the double bottom made in October 22, let's say in the Qs, and then the first week of 2023, double bottom, and then the massive lift, this is how you outperform over time, is you buy low and sell high. The perma bulls, although they may get the recognition on business television like, hey, great call, you were bullish this year, you didn't outperform at all. All you did was match the S&P, which is what any investor can do by simply being long spiders. If you don't properly anticipate and act off of when the market's going to come off and that you need to reduce exposure that you can put on at lower prices, that's how you outperform. And so I think you've got this whole group of people out there who have been telling you this year, it's bullish, it's moving higher. Yep. But thank you very much for just understanding that historically, U.S. stock market moves from the lower left-hand corner to the upper right-hand corner of your chart. Everybody knows that. The value comes from when you can play decent, multi-hundred point moves in the S&P to ultimately create a scenario of outperformance.
Yeah, that's a good point, Rick. But you know what? Hey, it's what makes the market, right? You're always going to have the perma bulls, you're always going to have the perma bears, and then you got these guys in the middle like yourself that are more than happy to play either side of those markets, and those are the ones that outperform the markets. Let's also talk interest rates because, boy, oh boy, it has been a very fast fall for rates across the board. But looking at the 10-year, it was pretty much at 5% at the tail end of October, and now it's under 4%. Rick, I know your target was right at about 3.92, I believe. That's right where the 10-year hit. How are you playing the bond market right now?
So it's interesting. We, as you said, once we broke down under, I think it was 4.72. I went out with two targets, 446 and 392. And obviously we broke through 446 a month ago, and we've been straight down and got to 392 last week. So I actually put out a tactical short of bonds to clients last Thursday to get into on Friday, just simply to play what's probably a 10 to 20 basis point rally in the near term, and then kind of look at the bigger picture. So if you go to summer of 22, when yields got down to, I don't know, about 2.5%, that uptrend line came in at just about 4% last week. So we dipped a little beneath it, but you're kind of near where there is some longer term support. Anywhere from in the near term, and I don't mean the next few days, but I would say the next month, give or take, I can make the case that yields could still potentially get to 3.68. At that point, they will have sold off so much so quickly that you will see a bounce, and likely a bounce that gets you maybe back up to somewhere in the 4.25 range. However, if yields have truly peaked for this phase, and again, I don't mean a 2-month phase, but for a bigger, let's look out a year. If rates aren't going back to 5%, I could make the case that in 2024, on a continued general decline in yields, you could get down to just about 3.2%. And that's about as low as I can picture in virtually any scenario at this point that yields would get. So I think 2024 becomes a year that you look to buy bonds on pullbacks, and my subscribers, get from me the specific levels when I see them come into play, and look for what still could be a move down to 3.68, if not all the way down to about 3.2. And that 3.2 would take out April 23's low at 3.25. And 3.25 is a long term, if you go back several years, 3.25 is a long term inflection point to the market. So I think we could end up playing with the 2023 low down at 3.25 and even tuck just a bit beneath it. But somewhere around there is probably as low as rates are going to get.
Very interesting, Rick. These are some of the key concepts, I think, to understand for next year, and stuff that we will be following along with, because they do have such an impact on all kinds of the other smaller sectors in these markets. But looking at U.S. markets and just how strong they're closing the year, the change in Fed stance, and the potential of yields actually rolling over, could be a very different year next year for markets. But again, this whole narrative of it could very well be a bull market that we are in, with markets continuing to move higher, even in the face of the bears and the perma bulls out there. But Ray, Rick, it's always interesting to hear what you're looking at, how you're playing these markets, and I can't tell you enough how much I appreciate you taking time with us every month on our show to share your outlook for these markets because boy oh boy, you're one of the best we have on the show. I really appreciate your time, Rick.
Well, thank you, Corey, for having me. I appreciate it, and it's my pleasure.
Very happy holidays to you and your family, Rick, and we will be chatting in the new year.
You too. Happy New Year, Corey.